Let's talk about JPI. It's one of the most popular income ETFs on the entire planet. I mean, it's pulled in over $30 billion from investors who are chasing that promise of high monthly cash flow. But lately, its performance has a lot of people scratching their heads. So what's the deal? Is the fund broken? Or is it just seriously misunderstood? Let's dive in and figure it out. And boom, right out of the gate, you can see the core of the issue. I mean, look at this. While JPI has delivered a totally respectable 8 or 9% total return, the S&P 500 has just rocketed past it, returning over 20%. It really does feel like you're stuck in the slow lane, watching all the sports cars just fly by. So what on earth is going on here? Why is there such a huge gap?
Okay, to really get what's happening today, we've got to rewind a little bit. We need to go back to the beginning and look at what JPI was actually designed to do and why it became this absolute titan in the world of income investing.
See, JPI launched with 3 really clear promises. 1, deliver high monthly income. 2, hold high-quality, low-volatility stocks. And 3, manage risk to smooth out all those crazy market swings. It was basically built from the ground up to be the antidote to market whiplash.
And that right there brings us to the heart of it all. This isn't a bug, it's a feature. This underperformance we're seeing, it's literally part of the design. JPI was never, ever built to race the S&P 500. It's an income machine, first and foremost. Everything else comes second. Now, that design philosophy worked like a charm in a sideways, choppy market, but the whole mood on Wall Street has shifted. I mean, it's changed dramatically. We're in a new kind of growth mania, and that has completely changed the playing field for a fund like JP.
And you know what? We've seen this movie before. This isn't a new thing. Back in 2021, when growth roared back, JPII lagged. Then, in the messy, choppy market of 2022, it was a star. It did exactly what it was supposed to do. But now, with this AI supercycle in full swing, it's been left in the dust again. This isn't some temporary glitch, it's literally built into its DNA.
So how does JP actually do it? How does it generate that huge income? This is where we need to pop the hood and look at the engine, because it reveals the fundamental trade-off that every single person who owns JPI makes, whether they realize it or not. The secret sauce is a strategy called a covered call. Now, don't let the jargon scare you off. It's actually pretty simple. In a nutshell, JPI holds a bunch of stocks, and then it sells the right for someone else to buy those stocks at a higher price in the future. In exchange for selling that right, JPI collects cash right up front. That cash is called a premium, and that's the money it pays out to you as income every month. So here it is. This is the fundamental trade. You get that awesome high monthly income from collecting those option premiums, but in exchange, your potential for huge gains is capped. You're basically trading the chance for explosive growth down the road for the certainty of cash in your pocket today. But wait, the trade-off doesn't actually stop with just capped gains. There are other, more subtle costs to getting that high yield that a lot of people miss, especially when you get into the nitty-gritty of how the distributions work, and, maybe most importantly, how they're taxed. Putting JEPI right next to its cousins makes this even clearer. You've got JEPQ, its tech-focused sibling, which did better because, well, tech led the market. But then look at SCHD, a simple dividend growth fund. It delivered a much better total return with a lower yield. It just goes to show you there really is no free lunch in investing. Every single strategy has its moment to shine. This is the number that gets all the headlines, that big, juicy 9% yield. It looks fantastic, right? It feels like you're getting a steady paycheck directly from the market, and that's an incredibly powerful draw. But here is the big catch, and it's one that a lot of people overlook. Because this income comes from options, not qualified dividends, it's typically taxed as ordinary income. We're talking rates all the way up to 37%. And that massive tax drag means your impressive 9% yield can very quickly shrink down to something closer to this. That's a huge bite out of your real take-home return, especially if you're holding JPI in a regular taxable account. So all of this doesn't mean JPI is a bad fund. Not at all. Far from it. It just means we need to reframe how we think about it. It's not about winning a sprint. It's about a steady, reliable pull. You've got to see JPI for what it is, a workhorse, not a racehorse. This quote really gets to the psychology of it all. For millions of people, especially retirees, The emotional comfort of seeing that predictable deposit hit their account every month just outweighs the abstract math of total return. And for that specific job, JEPI is an incredibly elegant solution. The problems only start when your expectations don't match the fund's design.
So, how can you use this tool the right way? 3 simple things to think about. First, be really honest with yourself. Is your number one goal income today or total return tomorrow? Second, if you can, try to hold it in a tax-sheltered account, like an IRA. That completely neutralizes the tax drag. And third, think about pairing it with a growth fund like VOO. That way, you get the best of both worlds, income stability and market upside.
And that leaves us with one final thought. There is no right or wrong answer here, only what's right for you. Buying JPI and then expecting it to keep up in a raging bull market is a bit like hitching a plow horse to a dragster and hoping for the best. So take a good look at your own strategy and ask yourself, is your portfolio built for a steady pull or is it built for a sprint to the finish?